Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel L. Conan, along with Spencer Israel, and we have Matt Tuttle on the line of Tuttle Tactical Management. Matt, how you doing on this volatile Thursday morning?
I'm doing great. The market looks like it's setting up perfectly for what we're planning on today. So
Okay.
so far so good.
And what are you planning on today?
Well, so we're actually going to be going in and doing some buying in stock. Coming into yesterday, we thought the market was looking overbought and due for some sort of sell-off. That happened yesterday, so that triggered a lot of our models to get in today, and it's looking accommodative there. We also went inverse treasuries the other day, and at least in the pre-market, it looks like treasuries are down, so hopefully that will continue.
All right, so what are you going to be buying?
Nothing exciting. We're
That's
buying
okay.
the S&P 500 today.
Now, do you buy the spider? Do you buy the futures? What's your preferred trading vehicle?
No, we'll be buying the spiders, and we'll be buying the iShares S&P 500, the IVV. Those are kind of our preferred trading vehicles on that.
Okay, and do you pile in all at once, or do you kind of use scale into your positions?
So we kind of myself and my head trader kind of look at that, see how the market opens, kind of get a feel for how things are going, and then we'll make a decision. Typically, we're not going to pile in all at once. The only time we might do that is sometimes we'll set kind of a pie in the sky limit order.
Okay.
That we don't think will get hit, but if it gets hit, great. If not, we might VWAP or do a little bit here, a little bit there.
Okay. Did you mention the IBB here is something that's on your radar?
The IBB is on our radar. As far as sectors go, biotechnology is something we're high on. It's just been a little too volatile right now for us. We've got a real small position in that, and would maybe look to see some of the volatility subside before we increase that.
I mean, look at that, 330 to 340. I mean, it's been trading in that range here since middle of November here. I'm going to put this one on my sheet here above 340. Looks like you got a nice move on the upside here. So unemployment tomorrow will be the key to the next move by the Fed. What are you looking for out of the Fed here in the number tomorrow?
I don't know that the number tomorrow matters that much. I think they backed themselves into a corner that, barring something catastrophic, they've got to raise interest rates when they meet again. If they don't, then they lose all credibility. Then nobody will have any idea what they're thinking, what they're trying to do, and that'll be a mess. So I think they're backed into a corner. I think they've got to raise rates. So really, to me, the more interesting, aspect of that is what kind of comes out around that. So if they're going to raise rates in December, great. But what are they going to do in the future? How supportive are they going to be? And I think whatever statement they come out with is going to be supportive. I think it's a one and done, and then kind of see how things go.
So you're looking for a last gasp rally that should last until the summer of 2016, and then we begin the next bear market. How do you come up with that projection?
So there's a couple of things. Bull markets don't last forever. As much as we would love them to, they just don't. And this market is long in the tooth. We are closer to the top than we are to the bottom. You kind of factor in some cyclical things. Seasonally, summer tends to not be so great as we saw this past summer. We think that was kind of the tremor before the quake. And we see a lot of things lining up. Now you've got the Fed exiting quantitative easing. At some point that'll start to pick up next year. I do think there are problems in China. I think there are problems in Europe. And I don't think the economy is that strong. And we think it all kind of comes to a head over the summer. But the way bull markets end, you need that last gap rally to get everybody on the sidelines going all in. And so that's kind of what our thinking is right now.
You looking at Brazil at all here? I mean, that market has come way off its all-time high here. You're looking actually over the last 4 or 5 days, it's come down from 26 and put a nice bomb here, 22.50. Anything in Brazil pique your interest, or you keep your money here in the good old United States?
We're keeping money in the United States. I can't find anything internationally that we like as much as is our market. We're tactical, so I'm looking at the momentum, and the momentum is here. Overseas, you might have some fits and starts, but the best momentum is still here.
So you are a fan of FANG then, huh? You're just looking for the strong to get stronger here. Facebook a little bit off its all-time highs. Amazon made a new all-time high yesterday, as well as Netflix and Google. So are those the Momo stocks you're favoring?
Well, we don't do much with individual stocks. We're more looking at styles, sectors, things of that nature. So, we'll hitch on to large cap, small cap, NASDAQ, or different sectors or different factors, things of that nature, not as much the individual stocks. And, most of it is momentum-based. We're looking for the strong to get stronger. But we also do a lot in mean reversion, where we look to buy into short-term weakness, which is why we're doing some buying this morning based on the weakness that we saw yesterday.
And you're favoring the industrials. What ETF do you look at for your industrials?
Again, we keep it kind of close to the vest. We like the sector spiders. So the sector spiders industrials.
What's the symbol on that one?
XLI.
Okay, XLI here. Okay. All right. I mean, that's bunching up. Had a nice rally off the flash crash low. Consolidating here. Boy, trading around the $55 level. So you like this little bit of consolidation here. So you're looking at that. What about the materials? What ETF do you look at for materials?
Same thing. Sector spiders. I believe that one's XLB.
Oh boy, this one's bunching up too here. Maybe break out of 45 here, and you might see some nice room on the upside there. And then consumer discretionary. What?
XLY.
XLY. Okay, let's take a look at that one as well. XLY, kind of quiet here, consolidating near the top of its range here. So, wow, above 80. Boy, you got some pretty well-defined resistance levels in this one. That 82 seems to be a good resistance. So, just, getting back to the Fed and bonds. You don't like anything in bonds right now, and you've gone inverse treasuries in the ETF TUTI. You're really taking the Fed's word for it here on interest rates going up.
Yeah, obviously interest rates are going to go up. You've seen a little bit of a rally off of the lows Treasuries made back in November, and we think we're now at kind of the top of that rally, and there's just nothing attractive in bonds, whatsoever. And yeah, like you said, we went inverse Treasuries the other day, and so far pre-market, that's starting to look pretty good.
All right, here that's a good take. We are getting another question here. Spencer, did you pick up the symbol on that?
So first, I want to get to Rob Hood. He has a question from Matt. Rob Hood wants to know: don't bear markets begin when the economy is peaking, rather than just getting by?
I mean, bear markets can begin at any time. There's obviously got to be a catalyst. And I don't know what that catalyst is going to be. We've seen a lot of potential things like, something horribly wrong in China, the whole European Union dissolving, or more problems in Greece, or something along those lines, or our economy slowing, or all of those things combined. And that's kind of what our thinking is. All of those things combined are going to come to a head at some point next year. But you've got to have some sort of catalyst for it. And we think we've kind of seen those things, and they're going to come back and bite us next year.
We do have a question from another guest who wants to know about short selling DYAX.
DYAX. I'm not familiar with that symbol.
Okay, either am I, but let me pull it up here. It had a nice gap up here. I'm not sure what the reason was. Brent, that it's not in play, is it? DYAX? Because
No.
it just
No,
had
no, no.
it's not in play. I don't know what the reason was for this big gap up here, Diax Corp, but I mean, it's just been marching down. It hit 36.68, and it's just been a slow leak down. Holding on here, 33.28. That's been the recent low of the move. I mean, it looks like it's trying to fill the gap, but I think I kind of would like to know the reason that it gapped up here. But it just seems to be going down, but doesn't seem to be any hurry. Finally here, just looking at small caps and mid caps over large cap right now. What the IWM still quite a bit off its all-time highs. What are you favoring here as far as large caps, small caps, and mid caps?
Yeah, so we prefer small and mid to large, and I like IJR better than IWM. It just works better in our models. It's kind of one half of one or one half of the other, but we prefer IJR here. We have a small position in it right now, but we'd be looking to add to that into any weakness in small caps, because we do think longer term we're kind of set up for small caps to do better than large caps.
Okay, we've been on the line with Matt Tuttle from Tuttle Tactical Management, joining us here on Benzinga's Pre-Market Prep. Matt, thanks for joining us. We'll talk to you again soon.
All right, thanks for having me.